Welcome back to video number 2 in Chapter 4. When we left off, we were talking about preventative controls, separation of duties. That's a big one. Physical controls. We lock things in safes, and we have maybe guards at the gate. We have proper authorization, so usually passwords on computers, but just as important as making sure that our employees are properly trained in what they're supposed to do and what authority they have to do what they have to do. And e-commerce controls are far more prevalent than they were several years ago. So we have to make sure that those are password protected and that we have antivirus software in place. We have a good control over all those electronic business transactions. Detective controls, and the big one in this chapter are going to be bank reconciliations. So here we're doing a number of reconciliations to periodically ensure that our physical assets agree with our accounting records. So that might be in the form of cash, like bank reconciliations, but also we might want to check on if we sold 5 units, do we find 5 movie t-shirts have been removed from stock that went out the door with the customer, or is there more that has disappeared? So also our performance review of our employees, that's an important part of the business processes. And then our outside independent auditors assessed our internal control procedures and hopefully detect any deficiencies or fraudulent behavior. The very first thing that the outside auditors do when they come to visit us at the year end is they sit down with the president, the CEO, and me, the chief financial officer, and we go through a very thick list of all the internal control questions that they have. A very, very long day, usually when we do that. So what the auditors are trying to do is find out where we're strong or maybe where we're weak. And if we're weak, they're going to put more audit effort into those weak areas and less into where they feel that we're strong. And each year now, the CEO and the CFO both sign a report assessing the internal controls adequacy. That's the new requirement based on SOX. And then the auditors then provide an opinion of that assessment. In our case, we had Deloitte, a Big 4 accounting house, do our financial audits, but we had Price Waterhouse do our SOX audit, another Big 4 accounting house. So they provide their own opinion on the internal control. So that's what the auditors do. They come in, and you're familiar probably with the fact that they test transactions and they try to ensure that what we are reporting is accurate. But the other piece of what they do is that assessment of internal control. Very important. All right, so if a company places cash receipts from the day in a safe or bank deposit box, what this would be an example of? And if you answered physical control, you would have been correct. It's important that we keep those cash receipts in safe places, like a safe or a bank deposit box. In my last position, we had a huge safe. It's bigger than the cabinet that's behind me. That only a couple of us had the combination to. So here is another excerpt from Regal Entertainment's auditor report. and they are assessing here the effectiveness of internal control. All right, limitations of internal control. An effective internal control system can't turn a bad employee into a good one, sorry that as that may be. Internal control systems are especially susceptible to collusion, a new word, I think, for most of you. And what that means is two or more people acting together to try to get around internal controls. Top-level employees who can override internal control procedures, like the CFO, for example, have that opportunity to commit fraud. So we have to ensure that effective internal controls and ethical employees alone can't ensure success or even survival. Okay, everyone in the company has an impact on operations and effectiveness of internal control, but who must take final responsibility? Is it the auditors, outside auditors, the top executives, the firm's attorney, the majority shareholder, owner? Well, if you answered bravo, top executives, you would have been correct. The CEO and CFO have to ensure that and assess whether the internal controls are adequate. And we sign off on that. By the way, if we knowingly misrepresent our financial results, we can be personally responsible for that. One of the very rare cases where the company's not responsible, but individuals are. All right, now we'll move from internal controls into cash. Cash is probably the most susceptible to theft loss. So we are very careful with how we handle cash. We're going to define cash and cash equivalents. Cash is just like you would think it would be. It's green cash. It might be at a bank account, or it might be in a petty cash fund, or we sometimes have short-term investments that we make with our idle cash that we can go grab very quickly if we need to, and that's called cash equivalents. So all of these represent the components of that total cash balance. And you can see them all. There are coins and currency and checks and savings accounts and checking accounts and debit cards and credit cards and cash equivalents. All total your total bank balance. Cash balance. Which of the following would not be considered a cash equivalent? Now, this one's a little difficult, but if you chose answer Delta, certificate of deposit that matures a year from now, that's not considered a cash equivalent. Normally, we consider a cash equivalent something that can be converted into cash within 3 months. But frankly, whenever I have had idle cash, I invested only in 1 month securities so that I can get at it quickly if I need it. The world is uncertain. Okay, now we're going to look at how we control cash receipts and cash disbursements. Cash disbursements is usually a term that students have not heard, but cash receipts is money that we get in. Cash disbursements are cash that we pay out. Cash in, cash out. So, some of those controls over cash receipts mean that the employee opens mail, an employee opens a mail and lists the check. A different employee deposited the cash and checks into the company's bank account. As soon as possible, a separate employee then records the cash receipts in the accounting records. And we accept credit cards or debit cards only to the limit of the cash handled. So you see there, we're trying to prevent collusion by having segregation of duties. The controls over cash disbursements should be almost always made by check, debit card, or credit card. We should authorize every single expenditure, and the authorizing employee should not prepare the check. Checks, as you would think, would be serially numbered, and in some cases required 2 signatures for large amounts. In my last company, I could sign up to $250,000, but I remember vividly depositing or making a wire transfer for more than $250,000, and I forgot about that requirement, and it bounced. Very embarrassing. A mistake I never made again, I would tell you. And then periodically, we're going to compare the debit and credit card statements to the purchase receipts, which have specified maximum purchase limits, and then we have a separate cash disbursement and cash receipts duties. So, just to talk about that for a second, if I buy a computer for myself, the process is, it's for me, so I can't approve that. Even though I have a big approval authority, I have to take my purchase requisition, I fill it all out, and I put down exactly what I want. I need 2 monitors, they need to be 4K resolution, my keyboard needs to have mechanical switch, my laptop needs to have 5 or 6 USB ports, right? And I put that all on the purchase requisition. From there, I walk that little beauty down to my boss, who signs off and approves it, because it's for me. Then I take that over to purchasing. Purchasing converts that to a purchase order, and in theory maybe gets 3 bids, and let's say they decide on Best Buy to purchase that computer. And then from there, Best Buy puts that order together and carts it over in their truck and drops it off at the plant. We don't take a check out to them right then and there. And then the quality control people, in this case the IT staff, comes out and checks to make sure that that computer complies with our purchase order. And let's say it does. So somebody puts that on a dolly and wheels it over to my office. The IT staff unwraps all that stuff and sets it up. And then we have a 3-way match called the vouching process in accounts payable. So they're going to get the receiving document, the purchase order, and the invoice from Best Buy. And they put that all together, make sure everything matches, and set it up for payment, usually within 30 days of the invoice date. So, when we make a check run, and when we do that check run, that check has backup behind it as to what the order was for that computer. The controller checks that all off, makes sure it's okay, and signs the check. And out the door it goes. You can see very easily how many functional areas are involved in that. We have me with the purchase requisition. We have my boss. We have purchasing. We have Best Buy and the invoice. We have the receiving department. We have the IT staff. Be very difficult for somebody to circumvent that and for me to buy a computer for myself without going through the proper procedure. Very difficult, and that's the way we want it. Okay, this looks like a good place for us to stop video number 2, and when we come back, we will talk about reconciling the bank statement. Until then, bye for now.